Hello, welcome. Welcome to our webinar. This is Ann Smart. I'm the director of the Loyola Family Business Center, and we're really delighted to have you join us today for what promises to be a really insightful and helpful education about strategies for monetizing private companies and shares without losing control of the company. I've got a couple of little pieces of housekeeping that we're going to go through, and then I'll give you sort of an overview of what our objective here is today, and then introduce you to our distinguished subject matter experts. So to start, those of you that are looking in, you'll see that there's a chat box to your right. Please feel free as we move through the webinar today to post your questions there. Depending on how much activity we have in the chat box, we may choose to jump in and answer those questions in real time, or we may hold them till the end of the webinar. I'm really, the other piece of housekeeping business really is to note that at the end of the webinar, we're recording the whole thing, and at the end of this, there are going to be a series of additional slides that'll be there as a point of reference for you. If you are listening to us live now, welcome, and if this is something that you come back to later because you've registered, we will be emailing the webinar recording out tomorrow to everyone who's registered. It will also be going out on social media, so you'll have another opportunity to both grab it that way or maybe forward it to a family member or friend. So thank you for that. I am delighted to have these distinguished speakers with me today. For a long time, Laura Clark and Stephanie Van Vlerah and I have been talking about this pickle that we sometimes hear family businesses find themselves in. And what I hear from family businesses often is that their primary asset is their business, and their wealth is tied up in that business. And they have questions about what are the practical ways that they can pull some equity out of the business or find a way to find some liquidity without losing control of the company. And along with that question often is, when I talk to certain providers, it feels like there's an agenda. So Laura Clark is the managing director of Oxford Financial Group, and Stephanie Van Vlerah is also a managing director at Oxford Financial Group. For the last 8 or 9 years, Oxford, led really by the leadership of Laura, has been a really important strategic partner and supporter of our Illinois Family Business of the Year Award. So I'll occasionally talk to them about these sort of challenges. And in our conversations, Laura and Stephanie said, you know, I think we could probably do a basic primer or overview of what's involved and what some of the choices could be. And we thought that it would be helpful for our members and other people to hear about. So we're delighted to have them join us today. And I'd just like to turn the baton over to Laura. Welcome, Laura.
Thanks, Ann, and welcome to everybody joining us today for the call. We're thrilled to be here. And as Ann mentioned, we've been longtime supporters of the Family Business Center and have very much enjoyed our partnership and getting to know many of you over the years. As Ann said, Oxford works with many families, and we'll talk a little bit about that. This is Laura speaking, and I have been in the family investment and holistic planning space for about 25 years. As has Stephanie, and we have worked together on many, many families here in the Chicago area and across the country. Oxford's origin actually was in holistic financial planning, including the topic we're discussing today. And Oxford, as a subject matter expert, was really on the forefront of what we now know as fee-only planning 37 years ago, which simply means that the fees we receive are the only fees we receive are those that we receive from our clients. We don't receive any additional compensation. And this is really important because it allows us to be your best advocate, to be our client's best advocate in any and all of your family's financial matters. And really the best way for us to do that is to have no conflicts. And as Ann mentioned, we work primarily with, and most of our clients are business owners like yourself. So as Ann said, the goal today is really just to describe the landscape of options available to you and your families and businesses as you're considering how to create liquidity, but still maintain some level of control of your business. We know from our work with Ann that working with the families we serve, how important family ownership is to many of you, and how continuing to operate a family business is very important to you. Again, this is meant to be sort of introductory in nature. Each of the topics we're going to talk about could be a presentation in of itself. And of course, we would be happy to act as a resource and have a more in-depth discussion on any of these topics, should that be of interest. So with that, let me turn it over to my colleague Stephanie to get us started. And we do have on the next slide, sorry. Got to cue Ryan there. We're going to answer the following questions, and you'll see them there. Again, how do you as a shareholder, large shareholder, small shareholder, minority shareholder, create liquidity without disrupting the success that you've created? And secondly, talk importantly about what the roles are and the goals of creating some of that liquidity. It may simply be for your own purposes, but it may also be to fund growth capital for strategic reasons or other growth strategies that you have for your company. Let's move to the next slide, and Stephanie will kick us off.
Thank you, Laura. Welcome, everyone. There are several options available for liquidity using the company balance sheet, and this illustration here walks through a couple of those different scenarios. Each has pros and cons, as well as varying degrees of changes in control. We'll describe these 4 potential options, each with varying degrees and immediacy of liquidity, as well as considerations for the trade-off in control for each of these scenarios. Typically, as you might imagine, maintaining control or the highest level of control requires sacrificing some level of liquidity or timing of liquidity. The first scenario here is a potential complete sale, which we recognize is likely not the desired outcome by most family businesses unless the family is intentionally seeking a complete exit. We do put it here for reference or relative in nature. The second step is maximizing liquidity is a majority recap. So a recapitalization where the owner may give up majority ownership of a business, followed by a minority recap. So a potential equity partner that have a minority percentage share of ownership. And then the last option that really allows the owner to maintain 100% control is a leverage recap. This is often referred to as a dividend recap. In this scenario, certainly there is the highest level of control maintained and there is no change in equity partners. Next slide, please. On this slide, we really get into more detail on each of these different strategies, and we discuss in more detail the benefits and potential risks of each option. Depending on your individual situation and specific desired outcome, of course, one option may be more appropriate than another, but we'll talk through the benefits and risks of each of these. The first, again, 100% sale, sort of one extreme scenario where the family is looking to exit completely. Lots of potential buyers out there, whether it's a financial sponsor, a strategic partner, or often family offices are pretty active in this space as well. This would certainly give up or provide the most liquidity available to the family, but certainly a 100% sale inherently is giving up control. The next two and the middle two columns, majority and minority recap, have varying degrees of liquidity and control. On the majority recap side, we typically see that for businesses that are either looking for growth capital or need a higher level of liquidity within the business, either to fund additional acquisitions or growth within the business, or to provide liquidity out to shareholders. So this is another source of outside capital that can provide liquidity for a variety of purposes. Certainly a couple of benefits here. I mentioned growth capital and new partners. There's likely a possible premium for change in control in this type of scenario where the owner would expect a higher premium for the price of the shares given the give up of control. And then lastly, the rolled over equity or any retained equity in the business would provide the opportunity for a second liquidity event or second bite at the apple. The considerations or risks in this type of scenario, as you know, inherently with giving up majority, you're giving up majority control of the business. So typically losing control of that board and 100% of control decisions. It's really important if businesses go this route that you choose a partner who, providing the outside capital, will be a good long-term partner and culture fit with the business, because certainly there's going to be a different level of interaction. In some scenarios, this may require meaningful levels of debt, and the majority owner, the new majority owner, would certainly participate in the greatest amount of upside relative to the prior owner in the majority recap situation. On the minority recap, that third column, again, another source of outside capital. The positive here, though, is the existing owners and family are allowed to maintain and retain majority control of the business. So this is often a great option for families who need some outside capital, are looking to raise equity capital outside of the business, but do not want to give up majority ownership. Certainly the trade-off here is a little less liquidity provided, so it depends on the needs and uses of liquidity. Again, the risk side, you're still adjusting to new outside partners, just as with a majority recap. Valuation is likely a little bit less because you're providing a minority stake as opposed to majority. And then lastly, the one challenge may be potential, finding potential capital providers. There are many more financial sponsors who like to take a majority position, but there are minority capital providers out there who are looking to partner with family-owned businesses. And in many cases, this could be a significant family office who would be a good long-term partner, or some more traditional financial sponsors. Now, the fourth column here on the leverage recap side, this scenario, we're talking about the family and business maintaining 100% control, so no change in the equity structure or shareholder stack of the business, but instead using outside debt as the source of liquidity rather than equity. This is often a case where the company has a really strong balance sheet, strong cash flow that would support an increased allocation to debt in the capital structure, provides liquidity to the shareholders via dividends, keeping in mind that any distribution would be made to all shareholders pro rata to their equity stake in the business. Typically, it's a pretty straightforward process depending on your existing banking relationships. Typically, senior debt lenders are supportive of dividend recaps or leverage recaps, depending on certainly the company cash flow, underwriting metrics, and overall balance sheet, and any prior debt that the company might have on its balance sheet. The benefit here, certainly maintaining 100% future upside. Now, the considerations or risk of this scenario, as you might imagine, is overall increased reliance upon the bank. So it's important to have really strong relationships and partnership with the bank if you're looking to increase debt. Added considerations around risk and growth constraints due to the additional leverage. There's no premium for change in control because certainly there's no change here. In many cases, the new debt structure might require personal guarantees. So this is really a partnership with a bank to provide that liquidity, but allows the company to maintain 100% control in the business with no equity change. Next slide, please. Next, we look at a variety of transfer options, and there really are many, many different options to consider when it comes to potential reasons or ways to transfer shares of a family business. These are most commonly used for estate planning techniques to quote unquote freeze the value of shares. This often comes into play if there's an exit of a family member from the family business and they want to transfer shares from one family member to another. Or another scenario is upon the death of a shareholder, the transfer of shares to other family members. And within the first row and different strategies here, a couple of things to point out. There are certainly a variety of trusts and different tools to utilize depending on the particular business structure, the desired outcome, and the family dynamic. A couple of things that I think are really important are considering your entity structure, as well as making sure whatever structure is in place that there are predefined buy-sell agreements and cross-purchase agreements within the family to avoid conflict among family members when the time comes to consider a sale. This is also the kind of perfect segue, and we'll talk about this when we get to scenarios later on in the presentation, but there's this concept of distinguishing between economic value of shares and controlling value of shares. So considering voting versus non-voting shares, and this is a nice tool when we're thinking about transferring shares or economic value of a business for a variety of purposes without having to sacrifice or give up control. So this is very common when we see estate planning strategies in place. Now, the second row here section is, in many family businesses, we certainly see the desire to take care of key employees. Often, and more so in family businesses than any other businesses, there's this appreciation for and reliance upon key employees that have participated in the business, whether they're family members or not. So we see that a lot where there's a desire to take care of employees and different opportunities to transfer shares or value to some of those key employees. One of the options we list here is the employee stock option plan, or commonly known as an ESOP. We won't get into much specific detail on ESOPs today, but that can be a nice opportunity depending on the parameters or characteristics of the company. And in the appendix of your deck, there's some more detail about ESOPs, which we could certainly come back to as well.
I'm going to talk about the last row of this slide, which is the sale to strategic buyer, private equity firm, or public. And this ties back to some of the items we talked about on the previous slide in terms of the sale and recapitalization. One important consideration, should you choose to go this route, is really understanding a lot about who the potential buyers would be and your capital partners. Even if it's a strategic sale, you can have quote-unquote friendlier buyers than others. So let me give you a couple examples. Warren Buffett is a classic example of someone who buys a business and really buys them to leave the management in place. He wants to own the business forever, and they are, for all intents and purposes, left alone as they were for the management to continue to run it as they see fit. A second example, and one that Stephanie touched on, is family offices. So these are typically single-family offices, and you may be familiar with some of those. But we've seen a lot more interest and activity here than ever before. And again, they can also be much friendlier purchasers or providers of capital. You know, we know of a family here in Chicago, and they have a very Buffett-like mentality. And their goal is to provide growth capital, even acquisition capital, but to really own those businesses forever. The other example I would refer to is businesses that are controlled, that even maybe public companies, where a founder or descendants still have quite a bit of decision-making authority and control. So think of that as strong influence. And I mention that again just as another example on the spectrum. So you can think of things like Facebook, the Ford Motor Company, where the founding family still probably has control over 40% of the shares. I mentioned Berkshire Hathaway as another example. Similarly, there's a range of types of buyers in the private equity space, if that's a route that you're going. So making sure that your goals are aligned with the buyer's goals or the investor's goals are very important. And again, a great advisor can help you on that front and make sure that through the process, you're speaking with the right type of resource for the goals that you and your family and business are looking to achieve. Next slide.
I think there are a few key takeaways as we think about wealth planning issues for shareholders. Certainly, first and foremost, there are numerous options for exit and diversification strategies. With all those options, the taxes are important and need to be addressed or mitigated to determine timing of when taxes are paid. Could they be deferred or mitigated in some way? Many clients and families we work with certainly desire to disinherit the IRS as they think about tax planning for their businesses. And thirdly, it's really important to prepare for any type of transaction or transfer in terms of looking at modeling of cash flows and the transfer of liquidity, creating a plan for income needs and cash flow, and then identifying any risks and how those might be mitigated. Next slide, please.
So in terms of thinking about your own situation in the business after liquidity, you know, what we've found in working with our families is that planning on the front end before you take any action is one of the keys to success. And again, our experience with families is that change can be difficult. These transitions can be a little bit scary. They can be intimidating. And modeling and planning can help mitigate some of those risks. Your business is undoubtedly one of your largest single assets, and as importantly, it is a representation of you in the marketplace, in the community, and of course represents the hard work and sweat equity that your family has put into the business for many, many years. So any type of liquidity that comes from the business needs to ensure that it's also going to be able to continue to provide for you and your family for your needs and your lifestyle. So we can't emphasize enough the importance of cash flow modeling, pre-transaction or pre-event, whatever it may be, to ensure that your needs are met. And you'll see on the bottom part of this slide, as a post-action for the financial modeling, is then to think about further down the line what you'd like to do with that liquidity. If it's really meant to be for you and your family to live on for many, many years to come, we talk a little bit about and start to get into the investment aspect of it, which is not our goal today, but we wanted to at least identify and note these items for your reference. Okay. I'm going to go 2 slides forward to page 9 and talk about a couple of scenarios.
We thought it would be beneficial to share with you a few specific examples of client situations we have experienced with our families to bring these concepts to life. There are 3 scenarios here, and the first example is a family member shareholder who desires liquidity out of the business for an outside investment. This is an opportunity where we might consider a dividend recap or a leverage recap scenario that we discussed using senior bank debt to provide liquidity to shareholders. And we discussed a few of these considerations in the earlier slides, but just to put a little bit more specific examples to the type of business where this might be a really nice option is one with a very strong balance sheet, capacity to take on additional debt beyond the general working capital or existing term debt that the company might have for general operations of a business. And then certainly a strong relationship with the bank and comfort level in terms of taking on some additional debt to provide that liquidity to shareholders. Now, some of the pros of this are easy way to provide liquidity, generally a pretty limited process, no change in control because we're looking at debt instead of raising capital or any change to the equity structure. The current business owner retains 100% of the future upside of the business, again, because there's no change in equity. So certainly a lot of benefits here under the presumption that the characteristics of the business support taking on new debt, but a pretty straightforward way to go. The cons or considerations of this type of strategy is the increased reliance upon the bank and increased leverage put on the company. Certainly the debt structure or covenant structure may be amended by the bank to support the new debt, and guarantees are may be required depending on the size and other characteristics of the business.
Can I ask a question there? So I think about this in terms of decision making, and we'll take this scenario here, and I'm thinking about shareholder view of taking on debt, especially if you have a company that has very little debt and hasn't, and is paying dividends. What is that? How do you advise people in that case about how do we talk to shareholders about it? Why would this be beneficial or not?
Yeah, that's a great question, Ann. And I think anytime we talk to a family about debt, whether it be in their business or personally, I think the considerations around debt are both a quantitative discussion and a qualitative discussion. People, both personally and in a business, have varying degrees of comfort level of taking on debt and what that might look like. So certainly anytime a business is looking to take on debt for this purpose, it needs to be a discussion either at the board level, at the senior management, at the shareholder level, to make sure that the shareholder group as a whole is comfortable with taking on new debt, understanding the benefit of it, because certainly any liquidity or dividend would benefit all shareholders relative to their percentage. But you know, debt is there are lots of facets to debt outside of just the pure economic. So that's as important of a decision around debt as the economic side of it as well.
And sometimes people have to make personal guarantees, and so that's another thing to leverage or think about and weigh. Do you have any thoughts about that in terms of this scenario?
Well, I think it you know, depends on the company, on the bank relationship, on the structure, but it's not uncommon to have personal guarantees be required by the bank depending on the specific situation. And again, I think that comes down to communication and comfort level amongst the management, shareholders, and people who would be providing personal guarantees, typically the largest shareholders. So there needs to be an agreement and you know, consistent viewpoint anytime it comes to taking on debt. And I think businesses that are more cyclical in nature need to be especially careful depending on where we are in a market cycle. I think it's important, you know, the last thing you want to do is put an unnecessary amount of leverage on a company to strain the company profit and success to be prepared for any type of downturn. So it's an important conversation, and using leverage very modestly for this purpose, I think, is important.
Thank you.
All right, next slide, please. The second scenario that we see quite often with our families is when a significant shareholder, typically the matriarch, patriarch, G1, or founder, desires to transfer shares for estate planning purposes or for other reasons, but does not want to lose control. And I think this is a key scenario and decision point for families. This is a prime opportunity to consider separating the economic value of the shares from the controlling value of the shares. And you can accomplish this by establishing voting and non-voting shares to really achieve that separation between value and control. Very common with S Corps. LLCs accomplish this with GP and LP interests. But the benefits here is, you know, it provides liquidity for the current shareholder. It's a wonderful estate planning opportunity because the current shareholder is able to transfer shares at a particular value that would be appraised by an outside appraiser based on that valuation, and potentially achieve some valuation discounts for lack of control or minority interest or lack of marketability. So from an economic standpoint, really attractive, but then still maintain the voting or control shares. The cons or considerations here, there's a documentation process for entity structure. Certainly something to discuss with your legal counsel anytime it relates to the entity structure of a particular business and shareholder class, and then potential IRS scrutiny for intra-family sales. But it is a very common strategy that we see for many different estate planning purposes or utilizing an individual's gift in the estate tax exemption.
So can I ask a question again to put you guys through your paces?
Yeah.
So I know we're doing scenarios that are really simplified, but oftentimes in family business, it's not one person, especially if you're in a third or fourth generation, you have multiple family members choosing to or looking to make their thoughtful estate plans, and each of these levers have an impact on somebody else, either the next generation or another branch of the family. How do you advise a family in that situation? It's a big question. I know. And we only have like 20 minutes, but go.
Yeah, no, it's an important question, and I think that speaks to each of these scenarios is sort of a simplified version of high level what we see families trying to accomplish and how we can use different tactics to do that. Every situation and family situation is certainly different. So when we're working with a family, we spend a lot of time with individual family members to understand their individual goals as it relates to wealth, liquidity, and transfer, both from a liquidity and control standpoint, and try to identify opportunities with different trusts or tools that we have to really provide the most optimal outcome for every shareholder involved. And it is important to figure out the desired strategy or what the first generation is trying to accomplish and make sure it's still in conjunction with what the next generation desires as well. And I think, one basic thing that we see successful families doing is just a really high level of communication. It's really important for each generation to communicate with the next in terms of what their desires are and what values and characteristics that are important to them and expectations between one generation and the next. And it's especially true between generations and when the next generation may have some members involved in the business and others who are not involved in the business who are still shareholders within the same family business. So that level of communication really helps provide a level of transparency and expectation setting, so that the combined planning amongst all individuals and generations is done in, sync with each other. Yeah, very often it's done in concert with each other, and having both generations work together to accomplish, to maximize the economic value for everybody.
Thank you.
All right, next slide, please.
Let's talk a little bit on the third scenario here, which is the company needs some growth capital or capital to make an acquisition. So this would be minority capital. And you can see the pros there on the left. Most importantly, allowing you to still have majority control, which we've been talking about as our theme here today, and still preserves the upside for a large portion of the remaining equity. It is important, though, as we mentioned earlier, to think about how the capital is going to come to play in the business, and that some capital is friendlier than others. And you always need to weigh sort of how much control you're willing to give up for that minority stake. On the con side, one of the biggest challenges is finding ideal partners. And as we mentioned before as well, considering their goals. Are they really in line with yours? What types of requirements are they going to have on you and the business, and types of metrics that you're going to need to meet? But the right partner can also provide some intangible benefits, such as strategic advice, other connections, other expertise that may be helpful to you as well. So let me give you a couple examples. We've got a few families looking to raise capital right now. One is a family out in Arizona, an entrepreneur like many of you. And he doesn't need a lot of capital, which is part of the challenge. Because right now, some of the people who are willing to provide capital are saying, well, I'm willing to do that for you, but you're going to have to give up an awful lot of control. So he's weighing whether or not he should continue to sort of go it alone and build his business up to a bigger point where more capital would be more beneficial. He might be able to make some acquisitions. But there's always that sort of trade-off. And I see we do have one question that has come in terms of more information about the types of firms or organizations in Chicago that provide growth capital. And the answer there, unfortunately, is not definitive for you. It really depends, again, on what type of capital you're looking to raise and really how you envision yourself as the CEO, the C-suite, your family members remaining in the business, remaining active in the business, and operating the business, because there are certainly all different sorts and types of capital providers, but it really would be a more in-depth conversation to find out, again, how much you're looking to raise, because different organizations need to provide a different amount of capital to make it worth their while, and combining that with your strategic goals and what you're hoping to do personally and for your family through the transaction. So we would be happy to discuss that further with you offline.
Yeah, I was just going to ask you, like, so just a scenario, if somebody's interested, because the question I often hear is, like, who do you trust? How do you know? So is that a conversation where you help source capital providers and work it through with a client?
Yes, that's a great question, and we can certainly do that. I think one of the biggest challenges for families, as we talked about, is this is and maybe totally new terrain for you. And as you said, how would you even know who is an expert or who would be a great capital provider in your space? That is something that we can do. If you've got a trusted financial advisor, they may be able to help you as well. Having worked with a lot of families and business owners, we really know who the experts are in some of these businesses, because we have helped families go out and find friendly partners to provide growth capital. Like what we'd like to say about insurance, and is if you're directed to a life insurance agent, they're probably going to sell you life insurance. But how do you know if you need the life insurance? Right. So that's really where someone like Oxford can help you discern what the options are and really figure out what you're trying to do, and then make sure that you're directed in the right way and to the right types of parties that are going to be able to help you and help you achieve your broader goals.
And then do you stay alongside them through the process?
Absolutely, absolutely. That's a good point. So one of the things we can also do for people is, knowing the markets, knowing what you should be paying for, what's a reasonable amount of control to give up, what's a reasonable amount of equity to give up for set amount of dollars. So in the example I used, one of our colleagues, Mike Rosen, is very active in this space, and basically has been on the phone with our client and visiting with them numerous times to say, if you're going to go out and do this, here's some things you need to think about before you even pick up the phone. This is what we would want to see. And if we didn't see these things, a crisp one-page summary, your financials and your books should look like this. So we started with that. The next step was, okay, how much capital are you looking to raise, right? Well, here are the 3 players that we know that are in that space, and this one happens to have an expertise in medical technology, which is your area of expertise. Let's start with them. And yes, we can absolutely help people evaluate whether or not what they're even looking at is reasonable for what somebody is, willing to give them for capital.
So we're hearing more and more about family offices that want to be evergreen, buying and holding for the long, like the Buffett. What's your interaction with that, and have you seen an emerging trend in that space, and how do you determine a good partner from a family office perspective as a capital provider?
I do think that's a very significant increasing trend, is the role of family offices and their desire to participate in owning and working with founder-owned, family-owned private businesses. I think as the public equity markets become more and more challenging, there's a desire to put capital to work in private companies. And a lot of family offices grew out of privately owned family businesses along the way. So there is a significant increase in desire from family offices to start to build their own portfolio of private companies within their sort of direct private equity type of investing that the family does. So certainly an increase there. When it comes to choosing the right partner, I think it's important to understand the particular family strategy. Some will have an industry focus based on whatever their expertise was in their business. And others like to, stick with their own expertise so that they can look to add value to the company. Because I think that's an important factor when you're looking for any capital partner. As Laura said, what are the other intangibles that they could bring to the table to help take your business to the next level? Strategic viewpoints or board positions or network, different opportunities that someone might have. So in many cases, family offices will have maybe a couple of industries that they work with, start to accumulate a variety of businesses to start finding synergies between businesses and combine together those family structure to drive greater growth value. But I think really having a conversation up front on what their strategy is, how much control they want to have, how long their desired holding period is. In many cases, we see family offices are much more patient capital than a financial sponsor. There's no defined exit strategy or timing that a private equity fund typically has because of their, by definition within their fund or their investor group, expecting an exit after a certain period of time. Family offices tend to be longer term investors by nature. They can be a little bit more patient, which can be beneficial for the family business owner as well.
That's great, thank you. Okay.
Well, just to wrap things up here in closing, we've covered an awful lot of ground today. I hope we've accomplished our goal of introducing you to a variety of potential options, some of which may be new to you. As you can see, aligning your strategy with the ownership model that you'd like to have going forward is really one of the key issues and is an ongoing evaluation process and involves how you're going to think about the trade-offs and the trade-offs with control and ownership. We'd be happy to act as a resource for any of you if you'd like to chat further or discuss any of the information in more detail, or if we can answer any questions.
Thank you, Laura. Thank you, Stephanie. This has been really helpful, and I think we probably could talk about 100 other things for less and less of time, but we're going to be conscious of people's time here. A couple of little pieces of housekeeping, just as a reminder that this webinar has been recorded. It will be sent out via email to everyone who registered tomorrow. It'll also go out on social media on our Facebook page and on Twitter, so please feel free to forward it on. And then let's just pretend 2 weeks from now you can't find that email. Feel free to call the office here at the Family Business Center, 312-915-6490, or email me at asmart@luc.edu, and we'll make sure that we get a copy of the webinar out to you. We do keep this webinar and any other webinar we've done prior in our digital library, so that's another opportunity later on if you'd like to come back to the subject. Just a couple of oh wait, I should ask, does anybody have any other questions? We had 1 or 2 questions posted, but sometimes what we find with our webinars is that people digest the slides later and have other questions. So I'm going to encourage you, if you'd like to compile a set of questions and you want to send them to me, we'll figure out a forum to get those responded to. If you'd like to send them to me, or also certainly feel free to reach out to Laura and Stephanie directly. Their contact information is part of the slide deck. Next slide. So a little heads up about what's coming in terms of programming and events in the almost second half of the year. Boy, the year goes by so fast. Our next big program coming up is the launch of our 5th year of the Governance Institute. The Governance Institute was designed and developed to help prepare family members to serve on both their own high-performing boards and to learn how to be high-performing board members. It's been an incredibly effective and robust program. If you have any interest in learning more about that class, please feel free to reach out to me, and I'm happy to introduce you to or connect you with either an alum or someone who's currently enrolled in the program. We're all about building community, and what I've found in the past is it's more effective for you to actually talk to another family business member than just listen to me. I'm happy to do that. Next slide. Okay, so this is going to conclude our webinar. I just want to thank you all again for taking the time out of your day to increase your education about this very important topic. And again, feel free to reach out to us if you have other questions at our email or go to our website, luc.edu/SBC. Thank you very much. And thank you, Ryan, for running the show today.